Suppose you ran an institution that was heavily endowment financed, and suppose you had decided in 1999 or 2000 that the correct payout ratio for your institution was 5%. What should you think is the correct payout ratio today? Assume that nothing else about your institution except changes in the economy has taken place. So there are a whole set of issues about how much you should care about today and how much you should care about the future and what about your future fundraising, a whole set of questions like that. I'm abstracting from all of those questions. And I'm simply saying, if you thought 5% was the right answer, or you thought 6% was the right answer in the late 1990s, what should you think is the right answer today? And I believe that the answer to that question is probably something below 3%. And I think that is a conclusion that is inconsistent with the behavior of most endowment-run institutions, is inconsistent with the planning assumptions of most pension funds, and is therefore suggestive of fairly consequential and serious problems down the road. Let me explain why I have that view. If you take 10-year index bonds in the United States or in Britain, where they exist, or you construct the most plausible proxies that you can construct for 10-year index bonds in Europe and Japan, you will conclude that their real yield has decreased by 300 basis points over that interval. You can argue that there are liquidity effects and that the bonds have become more liquid or less liquid, probably more liquid. You can make various constructions based on swap spreads, but you will have a difficult time, I believe, convincing yourself that the number is outside of the range 250 basis points to 350 basis points for a proxy for the global long-term real interest rate. You can construct inflation swaps, take inflation swaps from long-term nominal yields. There are a lot of things you can do. I don't think you're going to have an easy time getting to some answer different vastly from 300 basis points. Probably, if you took the calculation somewhat further back, you wouldn't have 10-year index bonds in the United States. But if you took the calculation back another 10 to 15 years, you probably would have higher proxy for long-term real yields. And so if the right reading of the stream of backward-looking evidence on real yields was X in the late 20 years ago, it is probably X minus 3 today. That's proposition 1. Proposition 2, there are an abundance of reasons for thinking that the fundamentals of the real interest rate have come down substantially over time. I think it is best to think of long-term real interest rates as being determined by the supply of saving and the demand for investment. There are a variety of factors that have increased the supply of saving: more wealth inequality, a higher share of income going to profits, more capital export from emerging markets, more uncertainty and longer life expectancy, raising personal saving, to take just some examples. There are a variety of structural factors operating to reduce the demand for investment: slower labor force growth, possibly slower productivity growth. Most importantly, the fact that capital goods have become much cheaper, and so the dollar volume of investment to purchase a given level of capital has come way down. My smartphone has more computing power than a Cray supercomputer did in 1993, when that Cray supercomputer cost $50 million. These observations come together in a news event of the last few days: Apple's decision to disperse $100 billion in dividends and share repurchases. Think about it. If the most successful, highest valued, technologically innovative growth company finds that it is so short of investment opportunities relative to cash flow that it is dispersing funds on that scale, something very important and structural is happening that is operating to lead to low real interest rates. So there is very little, I would submit, to suggest that this is likely to be a transitory phenomenon. If one looks at 30-year real interest rates, they are not much higher than 10-year real interest rates. And in some countries, like Britain, the real yield curve actually slopes downwards. If one thinks about these kinds of structural factors, particularly the demassification of the economy is likely to continue. Consider, for example, that law firms now need 600 square feet per lawyer, whereas they used to need 1,200 square feet per lawyer because there are many fewer paralegals and many fewer filing cabinets. Consider what the impact of Amazon is on the demand for mall space or the demand for warehouse space. So real interest rates are substantially lower. There is substantial structural explanation for the fact that they are lower, and that is likely to persist. Observation 3, which is kind of parenthetical, this is what is driving what many regard as troubling policy settings. Everybody says, not everybody, but many in the financial community, and I think they're mostly misguided, say, isn't it terrible the United States has such big budget deficits? Isn't it terrible that the Fed has such huge balance sheet? Isn't it terrible that interest rates are still so low when we have a 4.1% unemployment rate? Well, imagine that all those things were fixed at once. What would happen to aggregate demand? The economy, take 3% off the budget deficit, push interest rates up 200 basis points, and the economy is surely growing 2 or 3 percentage points slower. And that means that it is very close to recession. And of course, what I just said about the United States is even more true in Japan and in Europe. And so what are seen as imprudent exogenous policy settings are in fact better viewed as endogenous responses to the surfeit of private savings relative to private investment. Observation 4. What about expected returns on endowments? Well, the simplest model to have, the most straightforward model to have, the one that would come out of an elementary finance textbook, would be that risky assets have an expected return that's equal to the return on safe assets plus a risk premium, and that there is no necessary reason why a risk premium would need to be changed just because the riskless rate went up or went down. If you took that model, you would say that the expected return on a portfolio with given risk should have declined by 300 basis points. And so if 5% were your expected return, were your endowment payout before, 2% should be your endowment payout today. What plausibly has happened to risk premiums? Well, here would be at least a compendium of the arguments as I would understand them. On the side of believing that risk premiums have come down, you would have the considerations that lower rates and the need for return have caused a significant fraction of investors to increase their risk appetites, and that has led to lower expected returns going forward. You would have the observation with respect to the current moment that measures of price-earnings ratios do not appear abnormally low and perhaps appear abnormally elevated. That something similar is probably true with respect to price-to-rent ratios, and that something similar is probably true with respect to credit spreads. You would have the considerations, though I would tend to minimize their significance, that many believe that quantitative easing policies have operated to reduce risk premiums and encourage people to riskier assets. To the extent that term premiums have declined, it may even be that ex-ante returns have declined even more. Those would be the arguments that risk premiums have declined. The contrary arguments would be of the form, well, I don't think they're actually that persuasive. The contrary argument would have to be of the form that actually people have, for some set of reasons, become more risk averse, or safe assets have become scarce, and therefore they are commanding a substantial price premium, and that risk premiums have increased, perhaps because of a shortage of safe assets. Why anybody could suppose that during an era of massive production of long-term government debt due to enlarged deficits, that somehow there is a shortage of government debt that is artificially depressing its yield by inflating its price, I cannot fully imagine. But that argument is made. And so my reading of the evidence would be that the assumption of constant risk premiums is probably a somewhat optimistic assumption, and that it is actually quite plausible that risk premiums have declined. To the extent that risk premiums have declined, it would be reasonable to suppose that the appropriate payout ratio would have declined by more than the 300 basis point decline in long-term real yields. So far we've made a case for a 300 basis point, but probably with an add factor more plausible than a subtraction factor. Consideration 5. What about the ability to add alpha? If somehow the underlying market risk premium has stayed the same, but investors have discovered the ability to add more alpha over time, then, at least for those investors who have discovered the ability to add more alpha over time, it must be the case that there is a change in the payout ratio. But how should we think about that? It may be that someone in this room is really a genius and has figured out a really clever strategy. It might even be that somebody's figured out a strategy that's so clever that even though they manage several $100 billion, they can generate significant alpha. But by definition, the search for alpha is a zero-sum game, and that for everybody who gets positive alpha, there must be someone else who gets negative alpha. What are the most plausible theories of the provision of negative alpha? Retail traders. They are a much smaller fraction of the stock market than they were 20 years ago. Governments. They are much less active participants in central banks, in currency markets, and much less active in speculative markets generally than has been the case over time. There are more and more people who have removed themselves from the possibility of being negative alpha by indexing in one form or another, and therefore being zero alpha, limiting the capacity for others to earn alpha. And so I would suggest that the idea that for institutional portfolios as a whole, there is more alpha to be had than there once was is very unlikely. And in fact, the widespread adoption of the Yale model, for example, the widespread use of alternatives, the fact that the easy pickings from the carry trade, from convertible bond arbitrage, from collecting premiums on options have become widely known and exploited, would suggest to me that in all likelihood, the availability of alpha has been very substantially attenuated over time in ways that have not been fully matched by the declines in the fees of alternative asset managers. Similarly, the willing supply of illiquid assets has surely not expanded nearly as rapidly as the demand for liquidity premium through investments in private equity funds, suggesting that, as some research at Harvard a couple of years ago suggested, that the premium that private equity can earn over levered public equity has surely come down substantially over time. In some, lower risk premiums, more likely than not, less alpha, substantially more likely than not, lower safe rate by 200, 300 basis points, certain. Seems to me that it is basically impossible to escape the conclusion, if you are systematic in your thinking, that if nothing else has changed, payout ratios should be far less, or expected return assumptions in pensions should be far lower than has been the case historically. Why might I be wrong? I actually don't think I'm wrong, but here would be arguments I can think of in support of the view that I was wrong. One, well, gee, maybe this is all happening, but actually returns for the last few years have been terrific. That is exactly what you would expect if we were in a transition to lower required returns. Exactly what you would expect is a recapitalization of lower discount factors, and those gains represent a pulling forward of returns, not an increase in returns. And for those institutions who think that a large part of their revenues are yet to be earned, they are poorer, not richer, as a consequence of the developments that have driven increases in asset prices. So the fact that the news has been good for the last few years, I would argue, is a corroboration of the views I have expressed, not a refutation of the views that I have expressed. A second theory would be, well, this is all interesting and all that, but actually everybody was taking too little risk before, and these developments have driven them to take more risk, and so now they're going to take more risk, and therefore they're going to earn higher returns, and it's really going to be okay to be taking more risk, because after all, the risk will all mean revert in the long run, because it will, and they're really long run institutions, and it's all kind of fine. Well, maybe, but I don't think the evidence in favor of mean reversion has particularly gotten stronger over time. I am persuaded by the evidence, some deep sense there is mean reversion in markets. There's also evidence that there are long-run changes in expected returns, long-run changes in expected variances, and so from the point of view of a single investor, one should not be confident that the variance of the return over 20 years is lots different than 20 times the variance of the return over 1 year. So people might have been making a mistake in taking too little risk 20 years ago, but there's nothing particularly in the fundamentals to suggest that that was the case, and it would be kind of unlikely if all institutions of all kinds were taking more risk than they were 20 years ago. A third possibility is that we're headed to some El Dorado of high returns to capital that are going to be created all of a sudden out of all the splendid things that artificial intelligence is going to bring. Here it's important to remember that the average return to the capital and the marginal return to capital are something different, and what markets price is the marginal return to capital. And precisely because the investments are so fundamentally cheap due to Moore's law, it seems more likely that marginal returns will be reduced than that marginal returns will be increased. So I would put it before you that the correct view that roughly no institution in the world is acting on is either to explicitly acknowledge that their earlier thinking about payout ratios was wrong and that they should have been paying out more in the past, or to believe that the payout ratios on which they are currently operating are excessive, and that this ought to be a larger and more active subject of discussion in the endowment, pension, and institutional investment world than it is.